Okay, so I'm going to continue down this path of exploring how does business skills, and how do we prove work into the decentralized ecosystem as business people. Because I think I've started to nail asking the right questions is critical. So I described in my previous video a transaction that that we've run, and we've run it on chain. And the whole purpose of that on-chain transaction is to represent an off-chain transaction. And the goal of software is to do things better, faster, and cheaper. That transaction on-chain was 1,000 times more expensive than it should be. Minimally 100 times more expensive than its off-chain equivalent. Multiple orders of magnitude in the wrong direction. And that's driven by gas expenses. And so the key question that I drive into this, so even if that $700 of notional ether, notional value ether that we spent to do that transaction was 7 cents notional, I have to account that 7 cents of gas as a business expense inside my transaction flow. It needs to show up in my business general ledger, not just on the blockchain general ledger. It's got to show up in my business general ledger. My accountant needs to understand that. How is the marketplace dealing with that? So let's use my, say, 0.3 ETH was expended roughly in multiple transaction events through the wallet and the smart contracts that were being interfaced to drive the transaction. So 0.3 ETH across, I think, 7 or 8 distinct transactions on chain. And let's say the notional value of that was $700 USD. What software package, from an accounting perspective, is able to appropriately capture that, so I can maintain that on an ongoing basis and scale a business on top of that, that doesn't get bogged down with humans running wallet audits and smart contract audits to figure out the timestamps of the transactions, the amount of gas transaction fees that are being deployed into those transactions and on chain. And then how are we going to mark those things and represent those things from a tax perspective? What's the mark to market on the notional value? Is marking it to market appropriate notionally? And that's going to evolve, and that could be interesting. So, like, really core question there that matters, because to run a business, you pay tax. You might not pay taxes. The bigger the business are, the more successful the business are, actually the less taxes you figure out how to pay, which is a whole interesting conversation. But every business reports it somewhere. And so if an element of my business expense and what should be showing up in my GL somewhere is this 0.3 ETH to run this transaction that generated a revenue, negative gross margins, by the way, I account that, and that should be that's a deduction in my tax base. So I really want to represent that operational expense as expensively as possible, to tell the truth. But I need to do that honestly, defensibly, for sure. And how do I do that at scale? So, like, that's really, what software tax packages are out there? Have crypto tax packages evolved in a way that can be integrated into that business to make that back office function simpler? And then there's a bunch of cascading effects around that. That's on my overall cost of doing business. How do I start to hedge that out? How do I understand that? Because a sophisticated business has a tax strategy baked in. It's not my small business of me running around at the end of the fiscal year, getting my shoebox out and rolling up my invoices, my expenses, and sending it over to my accountant to total it all up and put it in the form correctly. Like a sophisticated enterprise is embedding into its business processes tax optimization and capturing a tax record in order to make that end of fiscal year, end of quarter, end of month GL reconciliation really clean, clear, simple, aligned with the tax strategy that enterprise has. It's a massive piece of enterprise business is organizing around what happens after EBITDA. Before interest, taxes, depreciation, and amortization. There's another level of accounting that happens underneath that. It's taxes, and so you want net earnings to really be as profitable as possible from 99, for most business scenarios. So how are we capturing that? And how do the products, like where do I allocate? Who charged me 0.3? Well, it's the Ethereum network, the decentralized network. What's that mean from a tax perspective? Like, usually when I have a business expense, it's because a supplier sends me an invoice or some sort of record, of which I have an on-chain record sitting in the wallet that says 0.113 was the transaction expense of interfacing with that smart contract. There's not that's not a double entry accounting thing because there's no real counterparty on the other side of the Ethereum network. It's the network. And so that curiosity from a tax perspective. So if you have answers around that, I'd like to talk to some people because, and I'm particularly interested, like if you're a crypto venture capitalist, you're a crypto hedge fund, how are you automating this? You're running a Uniswap DeFi function. How you piling that up here in April 1st in order to report it? Assuming you're reporting it, which some level of reporting will happen. How you get there is the important question. So would appreciate some feedback on that.